Bank failure, Fed, and interest rates, things that seem to be very opposite, they come actually very well together. And today I'm explaining why I genuinely believe that 2024 will be nuts for real estate based on what happened in March of this year with banks. If you may remember correctly, some of you already forgotten, in March of 2023, we saw major bank failures. So the most famous one was SVB, Silicon Valley Bank. Why did they fail? Because in the past years, when we had cheap money, let's say most of the money that they had deposited by companies, they used that money to buy assets, specifically treasuries and stuff. Now, the way treasuries work is when you buy them, you get some interest back at the end of the loan term. Basically, these treasuries are like a normal loan that the bank would give to you and you pay them an interest. Same thing happens with them. And they have a contrasting relationship with interest rates. So if you buy one of these bonds when interest rates are low, you buy them for a certain price. But if the interest rates in the market goes up, those loans, those bonds that you bought are actually losing value because you could buy other bonds that pay you much higher interest rate compared to what you own now. And so what happened is SVB, as many other banks, bought these assets when the interest rates were super low, expecting that we're gonna keep interest rates low. And as soon they started going up, the value of those assets that they bought went down and went down and went down, creating this little, let's actually quite big crisis they had. As the message spread, the companies wanted to pull out the money. These, banks didn't have the liquidity and they went insolvent. What happened then is that the Federal Reserve created a bank term funding program, which we're gonna look up right here. This is a way for bank to be protected in cases where these assets lose value. And basically the way it works is the Federal Reserve allows banks now to get a full loan based on the value of these assets to fund, any kind of movements such as depositors pulling money out and, avoid banks to go insolvent. This is important because we could have gone through an enormous crisis if this wouldn't have happened, as people maybe would have been, a little bit more insecure about the banking system, would have tried to pull money out, and we would have had many more banks than what we saw potentially go into insolvency. Now, what is the loan term of these, this funding program? It's 1 year. So when you loan money, you loan it for 1 year, for 1 year max. It could be shorter, it could be longer, but you're gonna pay an interest on those. And the interest is also based on the Federal Reserve interest rate. Pretty much going hand in hand with it. It could be different, it could be not. I'm not gonna look too much into that side of the thing. The fact is that banks have 1 year max to pay off these BFTP funds. And if we look at the BFTP, loans total amount, which is how much banks have been loaning in general, and we look at the Federal Reserve economic data right here, bank term funding program, we know that the number has been going up. Of course, March is when we opened, we saw billions coming in. Now we are at 123 billion, which since most of them started out in March, are due mostly, depending on the loan term, but it's mostly 1 year, on March of 2024. Why is this important? Why is March 2024 important? If you look at the last Federal Reserve meeting, the Federal Reserve basically said, Jerome Powell said that we haven't beaten inflation, but we are on a good trajectory. And they also said that there could be the possibility of dropping interest rate next year. If you look at what the market expects 2024 after that was said, a lot of people expect that the first couple of rate, decreases will start out in March of 2024. Why is that? I believe there is a big relation with these loans that were pulled out in March of 2023. The thing is, banks gotta pay back these loans, and at the same time, they want the value of their underlying assets on which they got these loans to grow back up. Right now, they are in negative territory, the value of those assets, because they were bought in when interests were extremely low and now they're higher. And so to, bail out the bank assets a little bit more, you need a Fed that starts dropping rates too. But if it does it too much, you could risk an inflation rise again, as we saw in the past couple of years. So you need to balance out this movement of helping out the bank assets helping out banks also to repay the loans and slowly getting into a more stable situation. So on top of having the inflation fight, now we have other factors that in the past year hurt the rest of the economy in other sectors such as bank, influencing interest rates. Expectation is already very high. Of course, depending on inflation, if inflation will go sky high again in the next couple of months, the decision of the Fed might change. The question is, do I bail out the banks or do I help out the American citizen? We'll see how much the two will have weight. What does this mean? If the market already expects a drop, and if the trend of inflation will keep going as it is, so a slow decline but a continuous decline, and if we know that banks need to be potentially bailed out or helped out because they're not in an extremely good position, especially the small ones, we could expect interest rates to go lower. As per now, what is the Federal Reserve Fed rate today? It should be above between 5 and 6. It is 5.25 to 5, and the expectation is that it drops to 5.525, so 25 base points down. And if we look at mortgage rates today, what is the mortgage rate today? So the mortgage rates are a mix between what the market expects and the Federal Reserve rate. Of course, it will be always higher because banks need to make money on top of the federal funds rate. And so if the banks are very insecure, the difference between the Fed rate and the mortgage rate will be huge. If the banks expect interest rates to go down, the discrepancy between the two will go little and little. And what we saw in the past 2 months is that the expectation is becoming more and more positive. And even though the interest rate hasn't really moved a lot of the Federal Reserve, the mortgage rates has still been going down. And this is the trend we see here from let's say November, actually this is October, all the way to December. So we started out at 8.09% national average to 7.27%. And if we look at the bank rate offers, what they're actually offering with their services or the people they know, I have no idea, this is not advice, this is what I'm reading here from the page, is 6.26%, which is basically almost 2 points, actually 1.7 points less than the peak we saw in October of 2023. And knowing that the interest rate could potentially are expected to go down even more, even without the Federal Reserve doing any movement in the next 2 months, if the expectation stays the same, we could see drops even more. If interest rates go down, if the Fed rate goes even down, if the expectation is confirmed with real facts, we could see the discrepancy even declining even more. And what does this mean for the housing market? Where is the housing market today? You see me doing updates all the time. I'm going to be as short as I can on this one. We know that we have homes are not being sold at the same quantity we saw 3 years ago. Actually, lowest point in history. Still, today we're down 4%, 5.3% total sale compared to November of last year. This is November to 10th of December data. So in the same period, we're down 5%. We know that we're not putting more houses for sale. Yeah, we're slightly up, 7% more homes compared to November and December of 2022. So we're putting more houses, more new listings, but we're still down a lot compared to 2021. And if I add 2020, a gigantic amount. Yes, we're still down compared to 2021 and 2020, which was an extremely, let's say, low inventory market. So we're not putting out enough homes on the market to let those prices go down. And you see it also reflected on the listing prices, which are actually up 5% compared to 2022. So not only did we not have a crash, we actually had an increase in prices even with high interest rates. What does this mean for the average American? We know that interest rates are starting to come back down and nothing happened on the Federal Reserve fund rate yet. We're expected to see a drop. Market expects the interest rates from the Federal Reserve to drop if the sentiment stays the same. And the Federal Reserve also confirmed that with data released on the last meeting, that potentially if the trends remain the same, they could drop interest rates in 2024. So low inventory, low new inventory coming on the market. Interest rates are already, as we saw, 1.7% lower compared to October, which was the all-time high in the past couple of years. And we're expecting interest rates to come down, which means that affordability will start skyrocketing back up. What does this mean? People that are on the market every day could potentially start coming back up. People that are a little bit slower will slowly be pumped by media. We could see initially a slow flow of buyers back in and then a gigantic flow of buyers. So the question is, how will sellers react? People that have a locked-in rate of 3%, when do they feel safe at potentially upgrading their house with a higher interest rates, but how high is the maximum they will be okay to accept to upgrade into a new house? As per now, if you locked in a 3% rate and you're living with your family and you're comfortable, and yes, you could have a bigger house, but it's not worth it to upgrade a 6% interest rate for you, you're not gonna tend to sell. But if the interest rates drop enough, you might put those houses back to the market. Keep in mind that most of the real estate market inventory comes from pre-owned homes, not from new homes. So the question is, when will the threshold come in where we won't only see new buyers coming in and flooding in the market, but we also are going to start to see sellers putting their homes mostly back on the market and pumping up the inventory numbers. But as per now, it looks very grim for the buyer, who is potentially expected to see lower interest rates, which is good for the buyer, but as more people notice that, you potentially could see more people flooding the market. So if you have been sitting on the sidelines, keep on doing your research, keep on finding deals. Now is still pretty good to do some negotiation, because if you look at data, you will see that list price and selling price, the selling price still seems to be a little bit lower than the listing price. So there's still some room for negotiation. But of course, as potential buyers could potentially come back onto the market, your negotiation amount could be slimmer and slimmer, because now you could potentially come back into bidding wars as we saw in the past. But of course, it depends on how many people will join the market back again. Guys, this is all for today. I hope this made sense. The Federal Reserve part is very complex. If you have questions about it, please leave a comment. If you found some value in this video, please like and subscribe, and I'll see you on the next video. Ciao!